I am honored to introduce Phong Le, the CEO and President of Strategy, who has done an exceptional job filling the shoes of Michael Saylor as CEO. It's no easy task, but Phong has taken the reins and brilliantly steered the company through its explosive growth. So please give a warm round of applause for Phong Le.
Who is excited to talk about KPIs? I actually am. Let me poll the audience and ask a few questions so I can understand how to calibrate this presentation. Who joined who is one of the 150,000 people that listened to our earnings call last Thursday? That's like almost all of you. Thank you. Second, who's actually taken a class in corporate finance in their entire life? All right, that's pretty good. It's like half of you. All right. And third, you guys are like knocking fists. Yeah, we took a corporate finance class. Third, who actually has a background in finance? Like, you worked in the finance industry. All right, not bad. Still got it. The Morgan Stanley guys did. Okay, this is my first time attempting to teach the new world of corporate finance or the old world of corporate finance. So it'll be a little bit fun for me. The only class I think I've ever really taught in my life was Fortran, which is a lot different than this. But let me just start with, we need a new BTC standard. And you guys are like, we have a Bitcoin standard, right? BTC stands for Bitcoin Treasury Company. We need a new standard. And I think you all agree with that. And I'll show you a few things that you're quite aware of. This is a chart of Strategy's EPS, diluted earnings per share, every quarter since we began the Bitcoin standard. And on top of that chart is our market capitalization, right? And when I had the team put the chart together, they're like, they had like that little thing on the negative $94 where it went off the chart. And I said, no, just show the whole thing. And it screws up the scale. But clearly, diluted earnings per share has zero correlation to the valuation of their company. And what happens is people will literally take some sort of a bot. I don't think they're writing this stuff. I can't imagine someone's really writing this stuff. There's like some AI bot that right after we release our earnings at 4 p.m. on a Thursday, an article comes out 5 minutes later that says, MicroStrategy loss widens as revenue falls, crypto holdings struggle. Terrible news. We had an awful Q1. Wall Street Journal, right? Bloomberg did a little bit better. Strategy doubles Bitcoin buying capital plan to $84 billion. And then you look at the actual article. It says they posted a record first quarter loss that resulted from the adoption of an accounting change, which we advocated for, that requires valuing their firm's massive Bitcoin holdings and market prices. Not inaccurate because they're using traditional corporate finance. I took my first corporate finance class in 2003. At MIT, and I was taught by Stuart Myers. Anyone know Stuart Myers? He wrote the book on corporate finance in 1988. And so I went back and I looked at the book and I said, okay, what were the contents? And for all of you, I broke it down. There are 3 major areas, something like 18 chapters: valuation and options, capital deployment and structure, corporate governance. 1988. I think there's on something like the 11th edition, no mention of Bitcoin. These are the summary topics in that book. And as you go through each of these, bonds, secure debt, asset-backed loans, stocks, equities, volatility, the options market, investments, NPV, which I'll talk about a little bit, capital deployment, right? That's actually meant to be DCF, discount rates, debt financing, equity financing, and go on and on. Investor relations, 8Ks, 10Qs, regulatory affairs, securities, commodity. Every single topic in here affects or is affected by Bitcoin. Not one topic needs to be ignored. Every single topic in corporate finance today needs to be rewritten. And so for Bitcoin treasury companies to work, we need to educate the world as to what are the KPIs and what are the metrics. And that's the framework that we really put out last Thursday and one that I'm going to talk about today. Right? And I'll put this into sort of 3 broad categories: BTC KPIs, This one, a lot of you are fairly familiar with: Bitcoin yield, BTC yield, BTC gain, BTC dollar gain, right? As potentially a reasonable substitution for something like diluted earnings per share. The second topic is newer, we introduced last Thursday, is BTC valuation. Think about this as any valuation you might do, right? You might say, hey, I'm going to buy that piece of property, buy some software, make an acquisition, capital allocation. You need to do a valuation. A lot of you do discounted cash flows, right? Perhaps we want to issue an asset-backed security, or Bitcoin-backed security. We need to do a valuation. And the third category is BTC credit, right? And you've heard us talk fairly passionately about the fact that the credit markets today don't value BTC, don't value Bitcoin. And so we need to create a model for that. So think of that as sort of the three sort of pillars of the framework that need to be created for the world of corporate finance to work correctly on a go-forward basis, right? So first, let's talk about the BTC standard KPIs, right? BTC yield, BTC gain, BTC dollar gain. The easiest way to think about this, as I mentioned, is a analogy to diluted earnings per share. What earnings are you providing? What income are you providing to your end shareholder without dilution? And we created some BTC standard metrics, right, that go along with those KPIs. BTC NAV, MNAV. We didn't create MNAV. One of you out there created MNAV, put it on X, and we're like, we like that one. So we started using MNAV, BTC premium, capital, spread, and parity. And so what do we do? Let's first talk about why are these KPIs? Why are they important? Ultimately, it would be nice if they became GAAP, metrics. It'd be nice if it was something that we could report on our earnings statement as we file our quarterly filings. It might be nice as something that you all be able to do too, right? And because if they're considered GAAP metrics, then we can stick them to our earnings report, right? And then Wall Street Journal can get some AI to write some article 5 minutes later that said MicroStrategy created 15% BTC yield achieved 13.7% BTC yield in the first quarter of 2025, and they're basically, at 90% of what they had targeted. That would be a much more accurate representation of the progress of the company. Or even better, even juicier, they created $5.8 billion in BTC dollar gain, right? And that could be a net income number, for as an example, right? That would be much more realistic and much more true about the performance of the company. And what we would encourage is for BTC companies out there, do that on a quarterly basis, state what your BTC yield is, what your BTC dollar gain is, et cetera, et cetera. And perhaps you might want to actually give guidance, right? We can't use the word guidance today. We use the word target because the word guidance means that we're talking about a GAAP metric. We're talking about a KPI, which is why we say target. And we updated our target at the end of each quarter. I encourage you, as you get more mature as a BTC company, to do something similar. And you could also use this to compare performance of different products, right? So imagine if you were a company that had multiple product lines, right? You're a technology company that sold both software and hardware. You could then say which segment of your business is doing well, which isn't, right? We offer Bitcoin-backed securities, right? MSTR, convertible notes, Strife, and allows you to have the relative performance at a point-in-time comparison of our different products, if you will, right? And let's go a step further. And I talked about this yesterday, and you hear us talk about this passionately. What's great about having these KPIs is we can start to provide them and report on them, not just quarterly, but imagine if you were doing it more frequently than that. In our case, we created a site. You might want to do so too, right? And I know there are other folks who have created sites that aggregate some of these KPIs, which I think is awesome. And we update ours every 15 seconds. The difference between updating something every 15 seconds versus every 90 days is 500,000x more transparency to our shareholders. And that's why this is important. Of course, you've never really had an opportunity in the past to make an investment in a project that literally 15 seconds later, you can let everyone know what the return on that investment was, right? You buy a property, you buy a piece of software, and that return on investment that you're getting might take 5 years, it might take 3 years, it might take 1 year to prove. Here you can prove it right away. And that's the power of BTC as a treasury standard. We also decide every week to publish an 8K with our acquisitions, and associated with those acquisitions, we provide the BTC yield and the BTC gain, right? And some folks are like, well, why don't you provide it more often? Because we don't want to, because it'll give you probably a little bit more insight than we want on sort of what our activities are in terms of ATM issuance, more insight in sort of how we buy our Bitcoin, right? But we think weekly is pretty good, right? We debated, should it be every 2 weeks, should it be every week? And maybe for your company, if you're not purchasing as often, it's when you make acquisitions, right? But that makes sense. Update your KPIs on whatever frequency makes sense for your company, right? So now let's talk about BTC valuation. And this is where I'm going to go a little bit deeper here and talk about how we value our different offerings and our different instruments. And also I want to talk about how we think about issuing equity and the dilution impacts of that versus issuing bonds and the less dilutive impacts of that, right? So first, valuations in general can help you make a capital allocation decision. It's very simple, right? Like if you sit at home and you decide, hey, I'm going to buy a house, or I'm going to buy a Lamborghini, or I'm going to buy Bitcoin, you do a valuation. And hopefully all you in here decide, I'm going to buy Bitcoin, right? Or even better yet, take your house, get a mortgage, buy Bitcoin. These are all decisions you're making based off of a valuation. And some of you just do it in your head. Some of you create a spreadsheet and you say, well, that house is going to appreciate, that Lamborghini is going to depreciate, and the Bitcoin is going to go like this. It's an obvious, you maybe look it out 10, 15, 20 years. It's the same thing we do. We decide whether to issue equity or a convertible note or a preferred note or whatever else we might do. We run a spreadsheet valuation exercise. Right? And some of it we do in our heads and we put on a spreadsheet. We want to share with you how to think about that. And to do so, you can't just use BTC yield, BTC gain, BTC dollar gain. You have to use valuation metrics. And as you know, the traditional valuation metrics don't work, which is why we created some new ones. BTC dollar income, BTC value, and BTC torque. So let's think about this a little bit. And I think the numbers are a little bit wonky on this slide, but we can sort of work with this. First thing, what happens if we issue $100 million of equity, right? What happens if strategy issues $100 million of equity? Well, of course, like any valuation model, you first have to take some assumptions, right? And in a traditional valuation, you might make an assumption of, okay, I am going to create a new product. It's going to generate a certain amount of income over time. It's going to generate a certain amount of profits over time. Revenue minus cost profits, right? Same concept that you might want to do with BTC, right? So that's the first thing you want to think about. And we start with BTC dollar gain, right? And so you want to think about what is the appreciation of BTC? What is the BTC ARR, right? In this case, we said, let's take 30%. Now, somebody might say, wow, you guys are crazy. 30% is really, really low. You should be going 50%, right? That's just an input assumption. Just like if you're creating a model, I'm going to sell a product and I think I'm going to be able to sell this much or this much or this much. You might create a sensitivity on some of the analysis, or this is the profits, create a sensitivity. Okay, so you plug in whether you think it's 30% or 50% or 10%, right? So that's one pretty important assumption, right? The other input is what is the MNAV, right? What is the premium to net asset value that the company currently has when it issues stock? We just went with 2x in this case. And as you know, if you issue $100 million of equity, if we issue $100 million of equity and an MNAV of 2x, that basically means that's $15 million of equity dilution to our shareholders and $50 million of BTC gain. right? That's where you hear Mike saying, I'm sell $1 for $2. That's what essentially we're saying we're doing for our shareholders. We're taking $1, we're producing $2 because we're priced currently of an MNAV of 2. And so you can imagine if the MNAV is higher, you're getting more BTC dollar gain, right? And so in year 0, what do we get? We get $50 million of BTC dollar gain. And then we have the $50 million of base Bitcoin that we're also buying, but that's dilutive, $50 million that's non-dilutive. This is such a simple concept, but when people talk about the dilution effect of what we're doing, it's not the $100 million, it's $50 million. And it's not a leap of faith, it's not a bad assumption, it's not funny math, it's just the truth. Finance guys, you agree with me? All right, so you have to start with that, okay? I'm glad you didn't say no. All right, so then any appreciation on the dilutive effect, that bottom white bar, right, is dilutive to the company, dilutive to the shareholders. Still good because you're getting 30% appreciation on it if that's your assumption, and you create $690 million in year 10 based on the 30% increase, right? The next piece is the $50 million BTC gain, which is static over the course of 10 years. And the final part, the yellow bar, is the income we make on top of that. The 30% appreciation is the money we're making as a company, right? It's the profits that we're taking. And so that's the BTC income, and that's the yellow bar. If you add the income and the gain, right, the 639 plus the 50 million, now you have what we call BTC value. Okay, the math is actually relatively simple, but it's good to sort of show how this plays out. Now, what's BTC torque? All right, think of maybe a return on an invested capital, perhaps, right? And that's 6.9x, right? So what are we taking there? We're taking the BTC dollar value, the $689 million that over 10 years we created that is non-dilutive to our shareholders. And we divide it by the $100 million of investment, 6.9x, right? Which is pretty extraordinary that over 10 years, we can provide 6.9x of torque value to a $100 million investment, right? Generally speaking, if someone says, I'm going to give you $100 million and you can invest it, in 9 years, you can return 6.9x on that. 6.9x return on invested capital. That's pretty darn good. You should be happy with that. So that's it. That's pretty much how this looks, and that's the model. And then we say, okay, somebody help me with the clicker, please. There we go. Then we say, okay, let's take some of our other instruments, right? And what does that look like? Our convertible debt would be the next thing, right? And as you get less and less dilutive, right, a convertible bond at $100 million is inherently less dilutive, right? Because we pay a coupon on that. We pay a little bit of interest on it. And so we don't have to convert it to as much equity. And so that's going to be less dilutive, right? Of your $100 million, $36 million of equity dilution, $64 million of BTC gain. It's beautiful. Why wouldn't you do that every day of the week? I'll tell you that later, right? But you get a BTC torque of 8.9x, right? Creating a little bit more value. And so we sat around and you heard the story. Mike asked the AI, well, how can they get even more BTC torque? Well, you try to do things that are even less dilutive. Strike being the next thing, right? Strike is less dilutive in that the conversion premium is much higher, right? It's further out, and the coupon that we have to pay is there, and that's dilutive because we have to pay for that coupon using our ATM, right? But on $100 million of strike, it's $20 million of gain, right? Or sorry, $20 million of equity dilution and $80 million of gain. And over the course of 10 years, now we're talking about 10.4x. You guys are getting excited now, like 6.9, you're like, yeah, that's good. 10.4x BTC torque. And the last thing we did is we issued Strife. And now you're saying, oh my goodness, this BTC gain, dollar gain, is infinite because there is no equity dilution to our shareholders, right? It's a perpetual preferred offering that has zero equity component to it. It's pure debt, right? Over the course of time, we have to pay a coupon on that, and you see that, right, in the white there. But for the most part, it's better, right? It's better from a BTC torque perspective, 12.8, almost twice what you saw by issuing equity at a 2x MNAV. Now, of course, you look at all this and you say to yourself, man, why aren't you guys just doing Strife, Strife, Strife? And are you guys crazy? Why do you even issue any equity whatsoever? I hear that. Some of you on X are saying that. Like, it's like, it makes no sense for folks to issue equity then, right? But of course, it does make sense because to be able to issue debt, right? The folks who value that debt look at our debt to equity, look at our leverage. And so to be able to issue more debt, we have to have more equity available. That's one reason why you can't just look at BTC torque alone by itself, right? Now here's an interesting view, right? It says if you have 1x MNAV, if basically Strategy's valuation, market valuation was $53 million instead of 106 or $53 billion instead of $106 billion. If you had 1x MNAV, then every dollar of equity we issue is dilutive because we're not getting any gain on it. And so you could go a step further and say that at 1x MNAV, it makes even more sense to issue debt, right? In fact, the further to the right we go, Strife and convertible notes and MicroStrategy, the better it is to issue debt. The lower the MNAV, the better it is to issue debt, right? 2x MNAV, it gets a little bit better. The comparison gets a little bit better. 3x, even better. And so as our MNAV increases, it makes more and more sense to issue equity because the difference in the BTC torque starts to compress, right? And so that's why for us, you know, creating a higher MNAV for all the reasons we talked about last week is important, not just to the equity, but to the debt too, right? I'm gonna skip this multiple stuff. And you see this in a BTC yield curve, right? And what happens in this particular curve is you see that the yield you get on your Bitcoin starts to compress and look more similar at higher levels of MNAV, right? And then the next slide does an even better job of showing this, is the BTC spread, and that's the percent of capital that we raise that results in BTC gain, starts to compress at higher MNAVs. So you would make an argument that at a 1x MNAV, you really want to issue as much debt as possible. And as it starts to compress, it makes more and more sense to issue more more equity, right? So we're starting to say, okay, number one, right, like on a BTC torque perspective, less dilutive instruments are better. Number two, as MNAV increases, that benefit of less dilutive instruments starts to decrease. And now here's the number three thing, right? Like, what is the BTC hurdle rate? What is the ARR that's required to generate positive income over 10 years? So this starts to tell you the opposite story. Because debt instruments have a coupon, you actually have to pay out every year, where equity we don't. You need a higher ARR and Bitcoin to support those debt instruments, right? So all of a sudden, it's not so obvious that issuing debt is better than equity in a scenario where you think BTC ARR may not go up as much, right? Last piece, two more metrics: BTC break-even price and BTC break-even rate. This is the price at which Bitcoin has to get to for us to generate positive BTC value over 10 years. Think of it another way. I'll say it more simply. This is the price that Bitcoin will have to get to for $100 million of equity issuance to work. And it's pretty extraordinary when you think about it. At 2x MNAV, BTC can be cut essentially in half. It makes sort of sense. Before, that's a bad decision to issue equity. When we get to 5x MNAV, we could withstand BTC going from $95,000 to $19,000 before that's a bad decision. Now you go to the other side, on the debt side, you look at something like Strife. Strife is not dilutive, not at all dependent on Bitcoin price. So it doesn't really matter what BTC price approaches, right? And has to be $95,000. If BTC price, Bitcoin price goes down, all of a sudden Strife is not such a good instrument. Okay? So now I've talked through three things that, if it was a single variable decision, you would all know exactly what we're doing, when we're doing it, and why we're doing it. But there's at least three interesting components here, right? BTC torque, the return on invested capital, favors the less dilutive instruments, right? Debt instruments, right? BTC break-even price and BTC break-even rate favors the more dilutive instruments as MNAV goes up. And the final component to all of this is the more equity we have, the more Bitcoin NAV we have, the better the pricing on our debt, right? Because it lowers our debt, our leverage ratio, our debt to equity ratio, or our debt to Bitcoin ratio. So those are the three sort of things we think about. And now you can't really take that and say, I know exactly what strategy is going to do tomorrow, right? But you can take that and help understand how we think about valuations, right? And I would encourage, right, as some of you are BTC, Bitcoin Treasury companies out there, to start to adopt this, just like you adopted the BTC KPIs, right? Because I think these valuation frameworks are quite essential in your decision-making as you decide what to do next, right? And this doesn't just apply to if you're solely a Bitcoin Treasury company and only hold Bitcoin, but if you're a miner and you have to make a decision between whether you buy Bitcoin or you invest in mining equipment, if you're a medical company and you have to make a decision between your next new product or whether you're going to invest in Bitcoin through an ATM or Bitcoin through some debt offering, a convertible note, et cetera, it helps you drive some of these decisions. Okay? You guys still with me? All right. I'm going to skip some of this stuff because it's good, but it's a lot. All right, so let's talk about credit. So we've talked about Bitcoin KPIs, BTC. I keep saying Bitcoin. I mean to say BTC because Bitcoin Treasury company, it gets confusing for everybody. It's like strategy versus MicroStrategy. So we talked about BTC KPIs. We talked about BTC valuation. Now let's talk about the credit side of the world, right? And this is an area that really just needs fixing, right? You heard our plea last week. We want to access a market that's 2.6 times the equities market, which is the bond market. I met a gentleman in the bathroom earlier today, and he was like, and no, it's not awkward to meet people in the bathroom. I think it's totally fine. He said, hey, nice to meet you. I help manage people's retirement savings. Do you have an instrument for me? And I was like, yes, we have an instrument for you, right? Like if you have $2 million in retirement savings and you're 70 years old and you want to take $1 million of that and put it in Bitcoin, right? But you never sell your Bitcoin, right? So you have to get earnings and income somehow. My suggestion is you take the other $1 million and put it into some sort of a bond, right? And today, like a bond that provides income, fixed income, right? And so if you have $1 million and you are happy with living off of 100K a year, you can put it into something that earns 10%. Guess what your options are to get a bond that earns 10%? There are very, very, very few, right? Some preferred instruments get you 8, 9%, but they have a duration, right? It can be called in 3, 4, 5 years, right? And they have risks associated with them. Strife is a perpetual preferred bond that gives you access to Bitcoin if you believe in Bitcoin and a 10% forever dividend. So you can take that $1 million and earn $100,000 a year and live off of that and live a okay life, right? That's the market we want to tap. And that's why people are in this market. It looks a lot different than the equity market, and it's huge. By the way, what do people do right now with that? They usually don't buy the preferred bond. They might buy some treasury bill, right? And you know what Treasury bills are earning nowadays and declining. They might buy a corporate bond, right? Or they might, especially if they believe in Bitcoin, buy something like Strife and Strife. And so that's why we're interested in this market. Why the market's broken, right? The reason the market is broken is because for the most part, bond valuations do not take into account Bitcoin on your balance sheet, right? Like the ability to get a reasonable rate, a reasonable payment from a corporation perspective, like to pay a reasonable coupon, is all based on the valuation and the risk associated with the bond. And so we said, all right, let's start from scratch and say, how would you create a credit analysis using Bitcoin for BTC companies? And the first thing we say is, and this is very normal in sort of a credit analysis world, is what is the likelihood that you will become under collateralized over a period of time? And we said for simple starting base, what is the likely you'll be under collateralized in 1 year? So if you have a $1 million loan, you have $1 million of assets, you're 1-for-1 collateralized. Everyone's happy. It's like anything bad happens, you take your $1 million of assets, you pay off your $1 million loan. That's a good outcome, good scenario. Your risk is reasonable, right? So we said, what is that potential scenario? And we said, okay, let's take our earliest duration, right, notes and our most senior notes, which are our 2028 converts. And we go and stack them one by one all the way down. 2028 converts, 2029. Our convertibles are more senior than our preferred notes. You put Strife and Strike below that. And what you start to see as we do this is the first note that's due in 2028. We have $52 billion, $53 billion. Actually, it's higher today. Anyone checking the Bitcoin price today at all? No one? It's higher. So we have more than now $53 billion of Bitcoin on a $1 billion bond. Very simple. The BTC rating is the amount of Bitcoin net asset value we have divided by the $1 billion. Okay? And then we start to stack that in a cumulative order. We see cumulative notional. And we say, as you go down the seniority list, the BTC rating gets lower and lower, all the way to the point of strike, where for a cumulative roughly $10 billion on a $53 billion asset value of Bitcoin, the BTC rating is 5.3x. Okay, so that's sort of step one. Let's think about a way to think about the risk in 1 year of not being able to cover your Bitcoin, right? And that's the BTC rating. And in the BTC risk, we say, what, based on a 50% BTC volatility, and this is just math, and a 0% BTC ARR, what is the actual risk of that happening? What is the actual risk in a 1 year period that we would be under collateralized, right? And the first step is for our 2028s, right? Where what is the risk that the $53 billion becomes $1 billion in a 1 year duration? It's zero. It's not going to happen, right? And you go down and down and down that stack. And now we have a rating, the amount of over collateralization, and the amount of risk, which is the risk that we will be under collateralized, right? So those two are fairly easy things to do mathematically. And then we say, what is the credit spread associated with that risk? And the credit spread is important because that's how these instruments get priced by the market. They look at the credit spread. And the credit spread is a more complex piece of math. We do the math between like these two, right? And then we let AI do everything in between. And it calculates what the credit spreads are. And this is why this is important. As you look at this, is the entire dislocation between the calculated credit spread, the price at which we should be pricing these bonds if all else was efficient, and the price we're getting, right? And of course, now you're like, hey, okay, I remember that conversation about the equity ATM. If we issue more equity, the BTC rating gets better as we buy more Bitcoin. The BTC risk goes down, right? The BTC credit goes down, and we pay less on these bonds as we issue more. That's why it's important that we keep building up our equity, right? So folks are like, okay, what about the dilution effect? It's also about what do you get priced? What do you pay for your debt? Those are two very important components. What do we pay for our debt, which is a reason why the equity is important. and are not covered in any of the BTC valuation KPIs. And of course, you look now, if you believe that Bitcoin is going to go up further than 0% per year, 30%, and keep the BTC volatility at 50, then all of a sudden you see the numbers getting even better, right? In this particular case, if you believe that BTC is going to go up 30% a year, which is generally worse than what we've seen historically, right? Then the BTC risk goes down to 1%, right, on our most junior note, which is Strife. And the credit on that is 13 basis points compared to a market credit spread of 700 basis points. And so we're paying a 687 basis point premium because corporate finance does not teach people about Bitcoin, and the debt markets don't understand Bitcoin. And so that's why we had a call of action last week that all of you, if you want this market to really work, right, it's not just about the equity, it's about the debt too, and why you all need to go help us teach the markets, the debt markets especially. Remember, $300 trillion debt market, 2.6 times bigger than the equity market, why this matters. And we've tried it. They are a tough nut to crack, the debt markets. These are not folks that want to say, hey, tell me about Bitcoin, right? They don't like talking about, things that have high volatility. They don't like talking about things that have 30, 40, 50% ARR, right? So, sorry, go back here. So that's the 30% ARR scenario. Now we said, all right, what happens in different ARR scenarios, 0, 10, 20, 30, to the different credit spreads, right? You'll see here, as it makes sense, right? As the ARR assumption gets higher, all of our bonds, all of our notes get less risky, right? Makes sense. And if you take a bigger look at this, you're like, okay, I don't really know. What does a 0% credit spread really mean? Right? What does a 10% credit spread really mean? Or 10 basis point credit spread? What is a 1,000 point credit spread? I'm sure most of you aren't waking up every morning thinking about credit spreads, right? The simplest thing to look at is what's in green here basically means your investment grade, right? So a BTC risk of less than 1%, right? Less than 1% being under collateralized on your loan means you're investment grade, right? Means that is something that somebody could go recommend most people invest in, even with your retirement savings, right? And as you get up to this red area, then you get to a place where you're junk grade, 3.8%. I never liked the term junk. I'm sure some really creative, debt person invented it. It's not bad necessarily. It's just your chance of being under collateralized grows. Okay. There's a lot more in here about credit comparisons, but I think you sort of get the point, right? Which is there is a dislocation in the bond market today. It's good that you do your own work, right? Don't let the rating agencies just do the work, right? Understand what a bond is worth. And now we provided a model to do this. Okay. What I'll note here is BTC volatility is going down over time, right? And even though, you've heard the term volatility is vitality, in the debt markets, volatility is risk. And as Bitcoin, as an asset class grows from 2 trillion to 3 trillion to 4 trillion, by nature, its volatility will go down over time. As its volatility goes down over time, what you'll find is the investability of the bonds that are backed on Bitcoin will go up over time. And so that's what we show here. Here is a $95,000 Bitcoin price and a 50% volatility. You see that what is sort of junk grade in that red zone at a 0% ARR is pretty high, right? And as we see over time, as volatility changes, right, which is what you see in these lines here, the likelihood that Bitcoin-based bonds sort of enter into that junk range. It gets lower and lower. Okay. The last thing I'll talk through, and I'll try to summarize this, is these three things work together, right? Like in sort of all of corporate finance, right? You need to understand your point in time KPIs, right? Valuations and decisions to make investments, and valuations and decisions to take on debt, right? True in personal finance, right? How much money did you make this year? What are you going to buy next year? And what are you going to borrow, right? As it is in corporate finance. We're going to, over the course of the next few months, publish a BTC standard model. Like we did last year, we published a Bitcoin model in 2024. We're going to publish a model and open source it and share it on GitHub and other places so that you all, if you're interested in understanding how strategy thinks about our investment decisions, you can start to build your own strategy models. But more importantly, as other companies adopt a BTC standard, they can start to have models and tools too. And we are extremely appreciative and understand the responsibility of being the first and largest Bitcoin Treasury company when we see companies adopt some of the BTC KPIs that we've established. Metaplanet, who you heard from yesterday, Cooler, who you heard from yesterday. And so that's the reason we want to publish this model, is so other companies can start to adopt it like they did the BTC KPIs. And probably most important for all of you is we need to educate folks, right? The Principles of Corporate Finance, written in 1988 by Stuart Myers, needs to be updated. And it needs to be merged with the Bitcoin standard that's written in 2018. We need a book on the BTC standard, right? We're writing the book as we go along. I think it's going to be the book that people will read and teach 20, 30 years from now. And it's exciting to be sitting here talking about the future of finance. So thank you very much.